Hello and welcome to our channel. Today, we'll be exploring a topic that has been making headlines lately, the state of the commercial real estate market. Sure, it's not exactly the hottest topic for casual chit-chat, but recent events have pushed it to the forefront of financial discussions. In the wake of the collapse of SVB and the regional bank crisis in the US, many experts have expressed concern about the health of the commercial real estate sector. And it's not just the average Joe who's having an opinion on this, it's high-profile figures like Elon Musk and Charlie Munger who have weighed in on the issue. And you know things are getting serious when even Elon Musk is worried about something. This is a guy who sends rockets into space for fun. If he's concerned about commercial real estate, maybe we should all sit up and take notice. Musk tweeted that commercial real estate debt is by far the most serious looming issue, mortgages too. Meanwhile, Munger, the vice chair of Berkshire Hathaway, warned that a storm is brewing in the US commercial real estate market, with a lot of troubled office buildings, a lot of troubled shopping centers, and a lot of troubled other properties. Adding to the warnings, Morgan Stanley has published research forecasting a potential crash in this sector that could be worse than the 2008 financial crisis, with a peak-to-trough price decline of up to 40%. That's right, we're talking a potential price decline of up to 40%. Yikes. With all these experts sounding the alarm bells, it's natural to wonder, is the commercial real estate market the next domino to fall in 2023? Or will it surprise us all and emerge unscathed, like that one guy in your friend group who always manages to avoid hangovers? I guess we'll know soon enough. So grab a seat and join us as we explore the state of the commercial real estate market and try to get a better understanding of what may lie ahead. So let's start with the basics. What exactly is commercial real estate? Well, it's not just skyscrapers and shopping malls, although those are definitely part of it. Commercial real estate actually encompasses a wide range of non-residential properties, from factories to hotels to office spaces and more. It's like a big game of Monopoly, except instead of buying Park Place and Boardwalk, you're investing in office buildings and warehouses. Now here's where things get interesting. Different types of commercial real estate carry different levels of risk, which is why investors tend to divide them into two categories: multifamily rentals, like condos and apartment buildings, and everything else. Multifamily rentals are considered the safest option because they're similar to residential real estate and provide a reliable, steady stream of cash flow. It's like investing in a gold mine that you know will produce a steady amount of gold over time. In contrast, other commercial properties like office spaces and shops are seen as riskier because their cash flows are less predictable, like investing in a slot machine. And when people talk about a potential crash in the commercial real estate market, they're usually talking about the latter category, not multifamily rentals. So why are investors and economists worried about US commercial real estate? Well, the reason boils down to two simple words: funding and valuation. You see, the commercial real estate market in the US is a behemoth. We're talking over $20 trillion in value here. That's like a lot of zeros. And here's the kicker. More than half of the $2.9 trillion in commercial mortgage loans are set to be renegotiated in the next couple of years, according to Morgan Stanley. The issue arises from interest rates, which have been steadily increasing thanks to central bank rate hikes. Interest and lending rates are now up by 350 to 450 basis points from just a year ago. And that, my friends, makes a debt even more unsustainable than trying to live off of ramen noodles and tap water. This will make the refinancing process difficult for some commercial real estate debtors, as rising interest rates limit borrowers' ability to desire to refinance mortgage loans. So, in a nutshell, we've got a funding problem. Next, let's talk about the problem of valuation. The COVID-19 pandemic has had a significant impact on the commercial real estate market in the US. With remote work becoming the new norm, office spaces are feeling as lonely as that one kid who ate paste in first grade. Vacancies are at an all-time high, with commercial real estate only 60 to 70% occupied, and office vacancies reaching levels we haven't seen in 20 years. As a result, some buildings are losing their value faster than a carton of milk in a heat wave, and banks are getting wary of lending to these older buildings, preferring to throw their money at newer, shinier structures instead. Plus, with fewer recent sales to go off of, it's tough for banks to know how much cash collateral to demand. It's like trying to guess how much money your friend spent on that new outfit without any hints. A total guessing game. So what does all of this mean? Well, nobody knows what a fair price for these properties actually is, which creates a bit of a problem when it comes to valuation. It's like trying to play darts blindfolded. You might get lucky and hit the bullseye, but chances are you're going to end up with a few holes in the wall. So what are the implications of a commercial real estate crash? Picture this. You're a savvy investor looking to put your hard-earned cash into something safe and stable. You've heard that commercial real estate is a pretty solid bet. After all, people need office space and shopping centers, right? But then you start hearing about all these issues the sector is facing. Funding costs, valuation problems, and to top it off, regional banks holding the lion's share of new loans. Suddenly, that solid bet isn't looking so safe anymore. And then there's a collapse of SVB and Signature Bank. It's like a scene from a disaster movie. Cue the dramatic music. The Fed and big banks are doing their best to keep everyone calm. But let's face it, when has that ever worked? If investors start panicking and pulling their money out of those regional banks again, we could be in for a world of hurt. Can you just imagine those banks having to liquidate their commercial real estate holdings? It would be like a giant game of Jenga, except instead of wooden blocks, it's multi-million-dollar properties crashing down. And nobody wants to be the one holding the bag when that happens. One of the immediate consequences of a crash is a decline in property values, which can result in significant losses for those who have invested in commercial real estate. This can lead to a wave of defaults and bankruptcies as property owners are unable to meet their debt obligations, leading to a broader financial crisis. Let's face it, a crash in commercial real estate is bad news all around. Not only do businesses that rely on commercial real estate, like construction and architecture, risk going under, but local governments could also take a hit in the form of reduced revenue from property taxes. And let's be real here, no one wants to deal with budget cuts and reduced public services. But it doesn't stop there, oh no. A commercial real estate crash can have serious implications for the broader economy. Banks that have lent money to commercial real estate investors could be in for a world of hurt, which means they might start tightening their credit and slowing down economic growth. And if property values start plummeting, that could mean less spending money for property owners and investors, which could mean less spending on everything from avocado toast to new cars. And let's be honest here, everybody wants avocado toast. When asked about the risk that commercial real estate poses in March, Jerome Powell, the chair of the Federal Reserve, stated that banks were still strong and resilient. Federal Reserve officials have stressed that the collapse of Silicon Valley Bank and Signature Bank were outliers whose failures had nothing to do with real estate. In fact, Silicon Valley Bank had barely 1% of its assets in commercial real estate. We're well aware of the concentrations people have in commercial real estate, Powell said at a March 22 press conference. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, and it is well capitalized. Remember, not all real estate is created equal. It's like comparing apples and oranges, or like trying to decide between pizza and sushi. Impossible, am I right? And according to the Federal Reserve, the rental vacancy rates are only at 5.8%, which is pretty darn low. And get this, vacancy rates in warehouse and industrial spaces are even lower. The national retail vacancy rate is only 5.7%. That's practically a full house. And despite the chaos of the past year, hotels are actually doing pretty well, with record revenue per available room. So things are looking pretty shiny for some sectors, except for office space, which is giving us major meh vibes. Now, I know what you might be thinking. What about the banks? Well, don't worry, they're not suffering any significant losses on commercial real estate. And there's little indication that companies will default on loans or rent payments, which is definitely a relief. The real concern here is the potential for a prolonged decline in mortgage values, which could cause deposit outflows and force banks to restrict lending to everyone. And let's be real, that's no bueno. But as long as developers keep up with their payments and manage refinancing risks, banks should be able to collect their payments as loans mature. So, fingers crossed that developers stay on top of their game. Of course, the real estate industry would love to see interest rates stabilize at their current level or even decline in the years to come. Because let's be honest, who doesn't love a good bargain? And if that happens, it'll be a welcome sign for the industry and hopefully lead to some much needed stability. So what are your thoughts and opinions on the matter? Do you believe that a potential crisis in the commercial real estate market could have a significant impact on the job market and people's ability to pay their bills? We would love to hear your thoughts on this topic, so feel free to leave a comment down below and join the conversation. It is always great to get different perspectives and insights on topics just like this one. Thank you again for tuning in, and we hope you enjoyed this discussion. Don't forget to share your thoughts and opinions in the comment section below. And if possible, leave a like and subscribe. More content to follow.